So let's look at what we have here. So under stating of opening stock, do we have anything about opening stock? So you're being told that opening stock is 1,400,000. Opening stock is 1,400,000, and whatever is given there is understated by 20%, which means the value presented to us is 80%. So if 80% is equivalent to 1,400,000, 80% is equivalent to 1,400,000, what are we going to have as the understated value? The missing 20%. The missing 20%. So the missing 20% will be 20%. We divide by 80%. And then we multiply by the value given to us, which is 1,400,000, which is 1,400,000. If you do that, you'll be able to get 350,000. Then the next one, still under that information, we have this figure here. We are told that sales and purchases are quoted inclusive of VAT at the rate of 16%. Purchases for the year, 43,600, well, opening inventory was that. The value for sales, do we have it? Do we have the value for sales given to us? Do we have the value for sales? The value for sales is given up here as 64 million. So we want to deduct, remember the income which was recorded here included the VAT amount, That is, if we remove VAT from this gross profit will reduce. This gross profit will reduce, which means it was exaggerated. So we want to do away with the exaggeration which was done to our we can now reduce that. Okay, somebody is saying that the note which tells us that the closing inventory is undervalued is not visible in this question. Can someone assist SIP? Can someone assist SIP on the information telling us that the inventories at each year end was being undervalued by 20%? Was being undervalued by 20%. If you undervalue closing stock in the next financial year, that closing stock becomes the opening stock. That closing stock becomes the opening stock. So do we have any information related to the opening stock? Do we have any information related to the opening stock? Okay, so that is now clear. That is now clear. So let's look at this one here. VAT on sales, we are told it is 16%. So whatever we are given here as 64 million is 116%. It has VAT of 16% and the normal rate that is 100%. The normal rate 100%. So how do we eliminate VAT from this 116? We simply take our 16%, we divide by the total value given, which represent 116%, we multiply by 64 million. We multiply by 64 million. Tukifanya hivyo tunapata ngapi? Tukifanya hivyo tunapata 275, 827, 586. So that is the VAT. That is the VAT which was exaggerated on sales, which should not be recognized as a revenue. So that's why we are deducting it there. Another item. So some people are asking me about the photocopying machine. The photocopying machine, which was given there. So my question is, we were able to see how we are able to see, pardon on VAT, sir. We said VAT on both purchases and sales are not supposed to be recognized as sales, and also they are not supposed to be recognized as expenses. So any VAT that is there should not be used to reduce or increase your taxable income. As you can see, our sales up here has got VAT, which means it is exaggerating. It is increasing our gross profit. So we have to remove it. When we come to purchases, which is an allowable expense, we find that it is placed there as an expense. So it was reducing our taxable income. It is an expense. It was reducing our taxable income. So to do away with it, we were subtracting it, or we were adding it back. It should not reduce our profits. So for the purchases, we added back because it was placed there as an item which reduces our profit. That's why we added it back. The one for sales was increasing our profits, and that's why we are deducting it. It should not increase our profits. Is that clear? Is that clear to everyone? Is that clear to everyone? Is that clear to everyone? By how much? VAT tuliambiwa ni what percent? VAT, Mayom, VAT tumeambiwa ni is what percentage? VAT, Mayom, what is the rate of VAT? What is the rate of VAT? 16%, so that is the answer. 16% is the rate which we are applying there. So for those who are asking about the photocopying machine, I want us to get it from this. Where is 64 million coming from? Can you look at the income statement and tell me the value of sales? Gisabo, what is the value of sales? What is the value of sales from the information given up there, the income statement? So that's where we got the 64 from. So we were having sales. Let's say we have sales here. Then under cost of sales, we have opening stock. Under cost of sales, we have opening stock. Okay, so once we have this opening stock, we add purchases. Then we less closing stock for us to get cost of sales. And then from there, we'll be able to get our gross profit. So opening stock to kind of 1,200, add purchases of 1,500, less closing of 1,000. Less closing of 1,000 for us to get cost of sales. So cost of sales will be opening, add purchases, less closing. That is what we have. So gross profit will be equivalent to sales minus cost of sales. So hapa ndani, inside our closing stock, ndani ya closing stock tuliambiwa kuna Is it closing stock or yes, closing inventory and includes a photocopying machine of 180,000. So let's see. This photocopying machine iko ndani ya closing stock. So we want to see how closing stock affects our gross profit. Our closing stock here is 1,000 and we have a photocopying machine of 300. So tukiweka hiyo photocopying machine inside the closing stock, see what we are having as our gross profit. So we want to remove it. It should not be there. It means our real closing stock should be of what value? Our real closing stock should be of what value? 700. So let's see. If we bring in 700, if we bring in 700 there as the real value of closing stock, tukitoa ile photocopying machine. Let's look at our profits. Imefanya nini? Our profit has reduced from 4,700 to 4,400. From 4,700 to 4,400. So what has happened? If you put the real value of closing stock, what has happened? Our profit, our real profit has reduced, or our real profit is now 4,400. It means putting the photocopying machine as part of the closing inventory exaggerated our profits. It exaggerated our profit. So if there's an item which increased your profits, but it should not be there, what are we going to do to rectify that mistake? What are we going to do? What are we going to do to rectify that mistake? Are we going to add it back up here? Are we going to less it down here? Okay, so for those who are asking me how to treat the photocopying machine yesterday, they were saying that we are supposed to add it up here. So whatever you are adding up here was placed as an expense. It was placed as an expense. It reduced the profits. It reduced the profits. That's why we were adding back. We were adding back the small tools. We were adding back the capital expenses like these ones here, tools and implements, computer software, because they were placed as expenses. But when an asset is placed as part of the closing stock, remember closing stock is going to reduce our cost of sales, which we now use to reduce the gross profit. So because it was placed here, it exaggerated the profit. Cost of sales reduced, and when cost of sales has been reduced, profit itakuwa higher, and that's why we are now going to do what? To subtract it to get our profit to the right place. Yes, so now we come here and put photocopying machine. Photocopying machine. Of what amount? Of what amount? 180,000. 180,000. So that is the value of the photocopying machine. Any other thing that is remaining there? Any other thing that is remaining there? So most of the things that you're going to deduct here is the allowable, which has not been deducted, and also any revenue that should not be recognized when you're calculating taxes. So gain on the sale of any asset, gain on sale of any asset which is received there should not be placed as an item that increases the taxable income. So you come to your income statement. After gross profit, there are normally other incomes. So the first item under other incomes, we have gain on disposal of property. That is fixed asset or non-current asset. The disposal of any non-current asset If it is an income, it should not be used to increase your taxable income. And therefore, we are going to subtract gain on disposal of property. Gain on disposal of property. The photocopying machine, yes. Remember, deducting it here is just to rectify the mistake which was done. The only thing we are now allowed, or we are allowed to use to reduce the taxable income is the investment allowance that we are going to charge against the photocopying machine. We look at that table and check the rate which is operating. Then we subject to the value of this photocopying machine to get investment allowances, which we are going to take care of in this particular place. Any other thing that is remaining? So gain on disposal of property, we have a value over gain on disposal of property. We have a value of this one here, 280,000. To mean capital expenditure is subtracted. Capital expenditure is not allowed to be an expense. Capital expenditure is not an expense because you are going to categorize it in the statement of financial position as a non-current asset. So you cannot tell us that when you buy a motor vehicle for the company, you put it as an expense. No, it is not an expense in the income statement. You've purchased an asset. In purchasing that asset, maybe you've taken a loan, which will be now classified under non-current liabilities. If you've used cash or the money of the company, you are now transferring your asset from the cash account to now the non-current asset account of the specific asset which has been bought. VAT on sales. So VAT on sales, this is what we have been given here. The value which is given up here is inclusive of VAT at the rate of 16%. This is what we've done. Sales includes VAT of 16%, and the value given to us is 64 million. 64 million kama iko na VAT hapo ndani, we have 116%, which means the real sales here, the real sales is going to be so sales plus VAT is 116%. Real sales is going to be 100%. So we need to get real sales. That is what we recognize as revenue. The VAT which has been included there should not be recognized as revenue because we are just collecting it from these people and we are going to remit it to revenue body. So let's get the real sales, that is 100%. The real sales, if 116% is 64 million, 100% will be what? 100% itakuwa ngapi? 100% itakuwa ngapi? %, itakuwa ngapi? itakuwa ngapi? So that one is the real sales. That one is the real sales. The real sales is 100%. The real sales is 100%. So it means what we are subtracting here, we cannot recognize as revenue, is VAT. Yes, taxable sales should be without VAT. exclusive of VAT. So kama VAT iko hapo ndani, we have to eliminate it, and that's what we did. So the value which you want to remove from this sales plus VAT ni kutoa VAT. Na VAT tukitoa, that is 64 minus real sales, we'll be able to get the VAT value. If VAT is the 16%, yenye tumesema it is 64 minus that to get VAT. Using this long procedure, another person who understands how these rates operate, you will be saying, if 116% is 64, 16% itakuwa ngapi? It is now where we are saying, if 116 is 64, 16% will be what? We now took 16%. Tukadivide na 116%. Close the bracket, then we multiplied by the value given up there, the 116%, which is this. If you do that, as you can see, we are arriving at the same value. We are arriving at the same value. Is that clear? Is that clear? Is that clear now? Yes, so that's what we did to get the value of VAT up there. So let's get back to this place. Any other item that is remaining? Any other item that is remaining there, which we need to deduct? Within the data given, any other item that is remaining? Any other item that is remaining up there? Let's check the additional information given. Let's check the information given to us up here. So we have dividends income, we have sundry income, that is the normal income. That is the normal income allowed there. Interest income. So this interest income can be from different places, and also this dividend. So we expect to get additional information down here, which will guide us on what has happened to the total dividends and also interest income. What about capital allowances? Yes, that one we are going to cover. That one, even if they have not mentioned it there, you need to know, because you've already seen you've seen depreciation there, you've seen the fixed assets there. So you have to look for these fixed assets and check the table and get the capital allowances. We are not going to reduce our taxable income using depreciation. So to take care of that depreciation, we use capital allowances. So we now get to this place under additional information number 1. Additional information number 1. Tukona what we call dividends income received from 1 Apex Limited associate company. Apex Limited, that's an associate company. They received a dividends of 240,000 gross. Dividends from an associate company is taxed or is exempted from taxation. Dividends from an associate company is exempted from taxation, and therefore this value is not going to be used anywhere in this particular question. This one, haina space anywhere. We are not going to use it. Then we have Jijenge Cooperative Society of having a value of 180,000. That is the dividends received from Jijenge Cooperative Society. So the dividends from cooperative societies are subjected to a withholding tax of what rate? They are subjected to withholding tax of what rate? Dividends from cooperative society are subjected to a withholding tax of what rate? They are subjected to a withholding tax of 15%. A withholding tax of 15%. So we have to bring in the gross value here. We have to bring in the gross value, the gross amount. What is given here is net. So it means they have deducted 15%. So what is the gross of these dividends? What is the gross of these dividends? What is the gross of that dividend? If 85% is equivalent to 180,000, 100% the total amount before deducting that withholding tax itakuwa ngapi? It is 100 over 85 by 180. Great. So what are we going to have? What are we going to have? What are we going to have? What are we going to have there? So we have dividends. And these dividends we have from Jijenge Limited. So Jijenge Cooperative Society. How did you find 85? Sasa mtu aeleze Molly how we got 85. Tumesema hapa tumeambiwa that withholding tax is 15%, is it? And the value indicated here is 180,000 in bracket net. Net, it means we may deduct 15%. Already we deduct 15%. So we want to take it back to the original amount before deducting the 15%. So 85% ni 180,000. 100% itakuwa ngapi? Is it clear now, Molly? That is Mollin. Is it clear? Is it clear now? Okay, so that's where we got that value from. So the income from Jijenge Cooperative Society, we are going to have 100, 85. We multiply by 180,000. We multiply by 180. Oh, I'm able to see I've inserted 110, not 100. Yes, so that's what we have there. Then we come to the next company still under dividends. We have Tower Limited company in Uganda. So these people have invested, they have done foreign investment. So the investment to the foreign countries or outside Kenya are also exempted from taxation. Is exempted from taxation. Is exempted from taxation. Yes, this one here, remember I've indicated it is other incomes. Other income. So what we are trying to look at, this one is supposed to be subjected to tax, but the only thing we are doing is we adjust it to the right value. They recorded 180,000. They recorded 180,000. So we have to take care of it. We have to take care of it by bringing it back. So what happens is this: someone may decide to just get the portion which is missing, aweke hapa, add back. Another person may decide that atoe hiyo dividends yote kwanza, the total dividends which was recorded up there, anatoa kwanza, then after kuitoa or after removing that dividends, after deducting it, so that's when they are going to come down here to put the entire value. I believe tunapatana hapo. I believe we are getting each other. That is what we've actually done. That is what we've actually done, Mayom. That is what we have actually done. Check this one. It is 100% divided by 85%, multiply by 180,000. Okay, please pardon. So what is happening here is this. You are deducting expenses. You are deducting things that are not, that are allowed to reduce our, taxable income. And we deducted them up here. So what we are now looking at is the dividends income. Remember, just look at where dividends income is recorded. Dividends income is 800,000. Dividends income is 800,000. So that revenue, yes, it is okay, but you want to look, it includes even those companies that are not supposed to be subjected to additional tax. The withholding tax is final. The withholding tax is final. So those ones where the withholding tax is final cannot be subjected to tax again, but they are part of the revenue recognized up there. So we have to eliminate them. So what happens is this, somebody will do this. Somebody will come to this section, it is revenue, atoe dividends zote, that is dividends. Akuje hapa afanye nini? Atoe 800,000. Deduct 800,000. After eliminating those dividends, everything, they now come here under other income to bring back what they actually are supposed to be subjected to this. Is that a particular reason we were told about Uganda? What if it was the dividends from a country that is not having a double tax treaty with Kenya? It will be subjected to tax summer. So if we have a difference, so long as it is outside Kenya, we are told that that one will not be, the withholding tax is final. So we are not supposed to subject it to another tax. So ingekuwa Uganda, Ethiopia, still it is tax exempt. It is exempted from tax. It is exempted from tax. So this is what I was saying. So hapa kwa dividends tumesema someone may decide to remove everything. Akishatoa kila kitu, the revenue for dividends hapa imewekwa 800,000 tushaitoa. So how do we get it back now? We only add other income, the ones that are supposed to be subjected now to tax. Tukasema this one here from associate company is exempted from, this one from associate company is exempted from tax. This one here from associate company is exempted from tax. The withholding tax is final. Sasa hiyo hatutaweka hapa. Ameitoa kabisa. It is not part of this. If we move to the second one, Jijenge Cooperative Society, any other income that is not from a SACCO, any other income that is not from SACCOs will be subjected to both, 15% and also this tax. So that's why we come and add it back here at the original value. That original value, we are adding it here because we deducted it, the entire amount to deduct. The entire amount was deducted. The entire amount was deducted. The entire amount was deducted. Then another person may decide, no, I'm not going to subtract everything. I only subtract those ones that are exempted from taxation, retain those ones that are going to be subjected to taxation. But what I'm going to do is I just look for the extra amount which is missing. The 15% which was deducted is what I'm going to add back. So that is what That is what is happening. So let's go this way. We deduct everything, then we add back what's supposed to be added back at the original value. So that's how we deal with dividends. Then we now move to interest. We now move to interest. So the first item for interest, we have interest from Tenzi Sacco Limited given to us at net, then Tilda Limited 135,000 given at gross. So Tenzi Sacco Limited, interest from SACCOs, interest from SACCOs, interest from SACCOs. Whatever is given here is net. It means they have deducted the 15%. So we have to add back. We have to add back the missing 15%. We have to add back the missing 15%. This one here is given at gross. So we just add back that gross value because we subtracted it. We subtracted it up there. We subtracted it up there. Interest income, tunatoa zote, we delete or we subtract all of it, and then we add back what is supposed to be added. So the interest income given to us, the total value is 420,000. So inside this 420,000, which we've subtracted, we now need to add back what was received from Tenzi Sacco and also Tilda Limited. Tilda Limited. So whatever was received from Tenzi Sacco here is net. So we adjust the missing 15%. Na jutulitoa hapa yote, we look for the missing 15%. The real value tutaweka if 85% is equal to this. 85% is equal to this. 100% will be what? 100% itakuwa ngapi? 100% itakuwa ngapi? 335,294 is equal to 100% divided by 85%, then we multiply by 285,000. 285,000. If you multiply, that's what we are getting. Then Tilda Limited, they were just trying to confuse you there. Interest from Tilda Limited, we take the full amount, but because you've been given the gross value, hiyo tuna transfer vileiko. We transfer the entire amount of 135,000. We transfer the entire amount of 135,000. We transfer the entire amount of 135,000, and that's what we have there. And that's what we have there. So once that is taken care of, there's an item which is remaining. That is there's an item which is remaining, that is capital allowances. Sasa tunakuja kuziweka hapa. The capital allowances. Let's put them here and list the assets which are going to qualify for the capital allowances. Let's put them here. So the capital allowances, the assets which we were deducting, or the assets which we are adding back. So if you come to this section here, tulikuwa na assets ngapi? Tulikuwa na tools and implements. We add computer softwares. So we have tools and implements. We have computer softwares. And then we also have what we deducted due to the way it affected our profit, that is photocopying machine. Photocopying machine will also be brought to that particular area. So let's put them with their values. The tools and implements. Okay, remember, even if you are to say that what to add and what to subtract, look at this photocopying machine. We are deducting it based on how it was treated or how it affected the profit. These other assets, which are also fixed assets, we are adding them back based on how they affected this profit. So if I give you like a standard thing that I tell you all fixed assets are supposed to be added back, then you add back this photocopying machine. Are you able to see the mess that you are going to get yourself into? Yes. So just look at how that information has been used when computing the profit or the accounting profit of this particular company. So from that point, you'll be able to interpret. Just have a small thing somewhere there, like this one here. You have your sales and see how it is affecting the profit. That one, you'll be able to understand how those items are affecting your profit and insert the right value at the right place. So tools and implements, I think we had 180,000. Then computer softwares, we had 56. So here we have 180,000. Computer, we have 56,000. Photocopying machine, we had also 180,000. So once we have that, sasa turudi kwa KRA website. Let's get to KRA website and check those rates. They are given. They are indicated there. They are indicated there. So what are we going to have? We have softwares, we have tools and implements. Computer software, 20%. Somebody saying 20%. Really? No, something is wrong somewhere. Computer softwares, hapana. It is not that one. It is not 20%. So I believe you are able to check using the link which we shared yesterday. But I can still show you that scale here. So that's what we have. Let's look at that scale. Let's look at this scale. So we have rates of deductions are as follows. We have capital expenditure incurred and the rate of investment allowance. So we have buildings there. We are looking for computer software. So computer and peripheral, computer hardware and software, calculators, copiers and duplicating machines. The rate is 25% in the first year of use, 25% in the first year of use. 25% in the first year of use. So it means when you now get to that particular question here, we've seen that computer software, whatever we are going to deduct, which is allowed, whatever we are going to deduct, which is allowed as capital allowance is 25% of the value of that asset. 25% of the value of the computer software. Then photocopying machine. Photocopying machine, what are you going to do with it? Photocopying machine, let's check the rate. Photocopying machine, we are being told here that we have We have computers and peripheral computer hardwares and software calculators, copiers and duplicating machines. So photocopying machine pia itakuwa ngapi? 25% in the first year of use. Photocopying machine itakuwa 25% in the first year of use. So we apply that rate. We apply that rate for the photocopying machine. Na tunapata ngapi? 45,000. Then tools and implements. Tools and implements, we said yesterday that we take a third of the cost. We take a third of the cost. And a third of the cost ni ngapi? A third of the cost ni ngapi? A third of the cost is 60. A third of the cost is 60,000. So it means the capital allowances which is allowed to be subtracted or to reduce your taxable profit is going to be the summation of these three figures here. Is going to be the summation of those three figures. So that's the total. That is the total capital allowance. That is the total capital allowance. So once we have this, we can get the summation of other income in this column here. We add these three. All these items here were being deducted. So we deduct, we get all these figures deducted. And of course, we need to see a negative there. So that's what we are going to have. That is what we are going to have. That is what we are going to have there if we deduct. That is what we are going to have there if we deduct. Then you come up here. This one here was what you are adding back. Then you adjust with the reported profit. So what are we going to have as the net value? So what you are going to have down here will be the taxable. What are you going to have here as the taxable income? Taxable income. Somebody to get us the value of taxable income down here. Taxable income, taxable income. Taxable income ni ngapi? The summation of these values in column Q. Summation of the values in column Q. Summation of the values in column Q. Ni ngapi? Summation of values in column Q ni ngapi? Yes, let me see your figures. Negative 16. Negative 16, 158, 134. So that is what we have there. That is what we have there as the taxable income. That is what we have as the taxable income, but I've seen there's a mistake somewhere here. 23,550 minus 71,42,400. Is it a negative or a positive? This 16,407. Is it a negative or a positive? Is it a positive or a negative value? Any positive or a negative? This 16. Is it a positive or a negative? It is a positive value. So something up here, maybe it was a mistake from their side. So this one here should be a positive value, not a negative. That one should be a positive value. So if that is a positive value, then this is what we have as the taxable. That is what we have as the taxable income. That is what we have as the taxable income. So once you calculate taxable income for a company, it is very simple. Tax liability. Tax liability will be 30%. Remember, it is always at 30. The corporate tax is 30%. So it will be 30% multiplied by the taxable income for you to get what they're supposed to pay as tax. How is it coming to positive? Sasa nimeuliza watu wanipatie this answer here. The total or the gross profit that these people have here is 23,550,000. And these are the expenses that they have subtracted from this gross profit, which is having a total of 71,42,400. Ndio nimeuliza 23,550,000 minus the expenses. Are you getting a negative or a positive value? Upper is 16,407. 16,407 ni ngapi? Mayom, get me the value here. 16,407,600. Is it a positive or a negative? That is this figure minus this. Gross profit or total income minus total expenses. Ni positive ama negative? Ni positive ama negative? So if it is a positive, this one here should not be a negative. If it is a positive, then if it is a positive up there, then the figure which you are picking or you are lifting directly should also be that same figure. It is a positive. So if you bring in that positive value there, I believe everyone is getting what we have down here as the taxable income. And if you go ahead to calculate tax liability, I believe we are all getting 49,97,120. Is that the case? Are we all getting that? Are we all getting 49,97,120? Are we all getting that? Are we all getting that? So if you go ahead and calculate the tax liability, you are answering part 2. You are answering part 2 of that question. That is calculate tax liability, if any, from the taxable income calculated in Roman 1 above. Calculated in Roman 1 above. So as you can see, we have 10 marks for part 8 to reach at this point of taxable income. Then let's come and look at the postings which were required. Here, we've done 1. This is the second one, 3rd, 4th, 5th, 6th, 7th, 8th, 9, 10, 11, 12, 13. So even this part only, if you do not know anything about deductions and you record the value up here, this one, the ones that you're supposed to add back, you put all of them, you will still get your marks. The 10 points there, you will still get them, even if you don't do anything on the reduction side. So don't waste time on struggling with something that you are not able to get at that specific time. Post what you understand and you move forward. You still get your marks. it is 15% that has been deducted. It is 15% that has been deducted. Whatever is remaining is 85%. So let's take it back to 100%. And that's why we are taking 100%, divide by 85%, then you multiply by the value given there as the net. We are taking it back to gross. We are taking it back to gross. We are taking it back to gross. So I believe for the videos, if you check those videos, I tried to give them the name. So you are going to see, just have the course outline and check. You are going to see the notes or the names of those videos indicated there. So they will guide you on the area of the syllabus that you are covering as you go through the videos. From number 1 to the last one, which was posted yesterday, and including this one also, I will give it a name. So you are able to see, if that's the name, then you automatically know the topic you are covering as you go through that video. So I believe we can end it at that point. So tomorrow we are going to look at the last thing, that is a investment deduction, which we have tried. We've just touched on them in the few areas for the investment allowances. So we are going to look at a question that everything you are given there is going to revolve around the investment allowances. You have the non-current assets, that is the factory building. We have land, processing machinery, power generator, the computers, the photocopying machines, tools and implements. Then at the end of the day, you are supposed to calculate the investment allowances. The name of those videos, if you click on the link, you'll be able to see the name written down there. You'll be able to see the name of what is covered in the video written down there. So I believe that's enough for today. We can just end our class at this particular point. You try to practice. I'll get you a video covering this and also some questions from this particular topic. So that's enough. That's enough for today. And let's say you have a blessed night, and let's meet tomorrow.